efforts, and now we've been doing it for so many years. We do the upfront work, and that upfront work takes you into the future because you've done the upfront work. It's the same knowledge being used over and over again. So staying on the chart now, on this day, I need someone with a calculator. So someone pull out a calculator, because I'm going to be asking you a number. On this day, the ATR is $5.79. The very next day, the market opened at 403.65. What is 403.65 plus 5.79? Again, what is 403.65 plus 5.79? That's going to be our first target. So someone please type it in. Waiting for someone to type it in. Open 403.65 plus 5.79. Okay, Van, you got 409.44. Okay, so on this day, we got our trade signal. We checked our setup. We went to our trading plan, went through every detail. We see a valid trade. We see it's 85 to 90 something percent winning trades. And a winning trade means the first target is reached before expiration. Expiration will be between 1 and 2 months usually of worth of option time. And that gets more specific as I'm working with you. That's all detailed in the trading plan. So the next day, we have to enter the trade at or below 403.65. And I'll show you some more details here in a second. That day, the high was 408.16. So it did not reach the target that day, which is 409.44. The next day, it did not reach the target. The next day, it did not reach the target. This day, the high was 413.67. So on this day, this target was reached, the first target. It was only, a few days ago. Okay, we're talking about February 1st here. Okay, on this day, when the market went up, this looked like it was Fed day, Wednesday, the target was hit. Now, when we buy an option, this is stuff I'll go over with you one-on-one when I'm working with people, but if you just buy an option, just buy a call or put, you really need to understand the option pricing so you don't pay too much. If you pay too much upfront for the option, then time decay can kill you real fast if it goes against you a little bit. So because you don't want to pay too much upfront, because you need to know that the movement in your direction will be adequate enough to give you enough profit to overcome time decay. So the faster the option moves or underlying instrument moves, better. But this could take two months to get to the target. It doesn't mean, so you have to know that even if it takes 1 to 2 months, that it'll still be profitable, and time decay isn't going to just totally crush your option pricing. And that's a little practice, but an observation. But that's basically our targets. We've been doing this for so long now, and given the people we learned this from, these using the ATR target, we expect the market to move at least that big a move in our direction within 1 to 2 months. And our trading plan will tell you what the stats are for 1 month and what the stats are for 2 months. Okay. And so we get an option with the appropriate amount of time. Usually we go for 2 months is the sweet spot pricing wise. If you got to go out 3-4 months to find an option, you start paying too much. So 1 to 2 months is the sweet spot for option. And we have a very set method of doing that to determine which expiration. Very specifically, there will never be any question as to what expiration we're using and a date. So let's say, okay, if you got in right at the open, your target would have been 409.44. But let's say you missed this day. You're doing whatever, you had other things to do. Or by the time you get to the market, it's already moving up, you missed the trade. Did it reach a target that day? No. Next day. Take a look the next day. You could have gotten in on the next day, or this day, or this day, as long as you're getting in at or below the open price. So on this day, the ATR was 579. Let's say you didn't get in this day for whatever reason. And personally, I've gotten to a point where I don't look to get in at the open. I look to get in at or below the open, but I'm very relaxed about my trading. The less you care, the more relaxed you are, actually, the more money you end up making. And so I've gotten to a point where I'm very, very relaxed. End up making more money by being very relaxed and not stressing to get into a trade. So let's say the next day, this first day, I'm not rushing to get up in the morning to get it. By the time I get up, it's already moved up. Yeah. But I see it didn't reach a target. Next day, I see it gap down. Okay. Let's say right now, on this day, and I am at 401. Let's say 401 is the price I'm at. We already know what the target is from the trade. The first target is 579 added to the open, which is 409.44 target. 409.44, somewhere up here is our target. If I were to get in just by chance, because I'm getting in on this day, because I didn't get in this day, I'm doing whatever, I had to work, I was sick, I was anything, I had things to do, family obligations, just couldn't do it that day. The next day, you're still below the open. Let's say I happen to look at my computer, it's now at 401. What is the difference, someone with a calculator, this should be an easy one, between the target, which is 409.44 and 401? What's that difference? This should be an easy calculation. What's the difference between 409.44 and 401? How many points is that? Difference between 409.44 and 401. Someone type it in. Difference between 409.44 and 401. Magesh, 844. If I get in when I saw it at 401, just by chance, I'm getting the first in the money option, might be the 401 strike. But now my target is $8.44. Here is how I am making more money by being relaxed and getting in a day later. Totally by chance. The entry is at or below this open. And you make a nice return. You're going to make 10, 15, maybe even 20% return at the first target just getting in here with a quick move like that. But now I went from having a $4.79 target to having an $8.44 target. Same trade, but I'm getting in a better price. I'm still buying the first in the money strike. So it might be the 401 strike. But now I have a much bigger target. All of a sudden, this goes from being a 10, 15, 20% return to being at the first target to being a 30 to 40 something percent return at the first target. Just by being relaxed. I'm in a day later. Not that I'm looking to get in a day later, it's just that you can't be in every trade. So I don't stress over trades. The majority of my trades personally are like this. They're not on the first day unless it opens that day and pulls back, then I might get in at a better price than the open. But I don't go looking for it. But a lot of opportunities happen. Even if I didn't get in this day, how about this day? This day, the market opened lower than it did on this day. This day, the open was 4,365. My entries at 4,365 or below. This day, the market opened at 4,113. I can get in anywhere below 403.65. Let's say I didn't get in this day, or this day. On this day, the market opened above my official entry price, then came down. When it came down, I could have gotten in below 365 on this day before hit the target on that same day. So I had 4 days into this trade. One day I could have gotten in here, I could have gotten in here, I could have gotten in here, I could have gotten in here. So I have 4 days to place this trade. Very relaxed trading. I know we have some people who are coaching clients right now who are discovering this as they've been trading for a few weeks or a few months, and they're looking for these type of opportunities now, because that's how you make the bigger returns. And it's a quick, easy way to make bigger returns by not, like, if you get in right at the open, great. Some people like to get it over with, don't like to think about it, don't like to track what trades are still in progress. They're just in, done. Some people who are like me, because I've just evolved to a point, I don't stress over it. I think Becky's the same way. She'll go looking, let's see, what trades are still in progress that have pulled back where I can get in at a better price than expected. Let's see, she'll look, okay, yeah, this one hasn't hit a target yet. Once the target is hit, trade's over. There's nothing to do. But before the target's hit, as long as you're at or below the entry, you're good to go. Note I haven't talked a whole lot about option analysis. There isn't a whole lot to talk about. We got this down to a science where we just buying calls or puts in the first in the money option. It's a matter of which expiration is going to be. The only option we deal with is the third Friday of the month, not all these weekly things that expire every week. Those options have only existed since in the last 10 to 15 years, realistically. We deal with the options that have been around since pretty much day one. They expire the third Friday of the month. Those are the only options we deal with. Okay. Not all the new fancy ones that expire every week. Third Friday of the month, the only option we deal with. And I've always asked about how much money you actually make. So one of my coaching clients a few years back made all of his trades public because he was so proud of his trades. He even did a presentation with me. I went looking for the actual presentation, but no longer online. That site was shut down a couple of years ago. Once COVID was going, person who was running it pulled it down. But I'll show you what his numbers look like, and that hasn't changed. The percent return hasn't changed. As long as you have that 1 ATR target, and sometimes you have a 1.5 ATR target, even bigger, but he did the basic 1 ATR target. I'll show you what the numbers look like so you know what percentage-wise to expect. So this is his live trading account, Real Trades. And I said the date's maybe 2014, but that hasn't changed. The percent return does not change as long as the same target, same percentage returns. Over 84% return wins, and 1 ATR target. Percent return does not vary. It's the same thing over time. So he risked about $1,000 on long trades with calls and between $500 and $1,000 worth of puts. This was only 1% of his account. He had a $100,000 account. He risked 1%. Eventually, the goal was 2, no more than 3%. So we'll take a look at the numbers, but take a look at what the percent return was on a particular trade. This is what it is. This is how much money he made, and this is a percent return on each particular trade. He just kept placing trades. Ideally speaking, you want to place 10 to 15 trades a month, and you're set. The numbers game, 10 to 15 trades a month, and the numbers will work out in your favor. Let's see. So percent returns again. If a trade is meant to be a 30% return, it'll be a 30% return. If it's meant to be a 1% return, it'll be a 1% return. He did a pretty good job of following the rules, which we showed him. And we don't get to tell the market what we deserve to make. We don't tell the market when it has to move. We don't have any control over the markets. What we do have is the ability to position ourselves in a way to capitalize from market movement, where the odds are in our favor of making money. But whatever it is, okay? So he was doing, in most cases, first target and second target. I know most people started with just doing first target only. Doing second target requires more time in your day to manage positions. Not everyone is willing to do that. So if you did nothing but first targets only, meaning your order is filled to get in, you put in your exit order and walk away, carefree, nothing else to do. It'll either be a win or a loss. If you do nothing but that and risking 2 to 3% of your account, you're looking at a 10 to 20 something percent annual return on account. If you do the extra work, that's how you get to the 20 something, 30, 40% annual return, is by doing the extra work. Okay, but that does require extra time and effort and position management. Not everyone wants to do that, has a desire to do that. They'd rather just grab their 10, 20 something percent return with the first target, and they're good, happy with that. As long as you're placing at 10 to 15 trades a month, the numbers will work out. If you want to make bigger returns, there is more work to do. So that's how I work with people to figure out what works for them. Okay, and also your account size does play a factor. You got to have enough money to buy enough contracts to do multiple positions. So again, dollars made, percent returns. And this is, I think, was 7 months of trading. And just keep booking profits, and the profits add up. Sometimes you might be thinking, well, you don't realize how much the numbers add up until you see the bottom line. Because a big part of how we make money is by not losing money. We make a lot of our money literally by not losing money. Okay. And this kept going on and on and on. And when it's all said and done, massive return. Eventually, a couple of losses happened naturally. Eventually, it came out to a 6-to-1 return. Approximately, not but about a 5-to-1 return. That means you're making $5 to every $1 made, was the final number. Right. And that is basically awesome. So if you ask a lot of presenters who teach educational classes what expected P&L is, they'll never be able to tell you because they've never actually done it. It's a theoretical. So it's when someone like this is willing to share, because he traded this strategy dedicatedly. Now, no other strategy, only traded our strategies in a dedicated account. So he was able to track this and document it. But this is kind of normal, what to expect. Eventually have a couple of losses, so numbers still work out extremely well. And he had a couple of losses, no big deal. Like I said, it eventually came out to a 5-to-1 return, meaning you're making $5 for every $1 lost. So we're going to switch back to